Okay, let's do it. Welcome aboard, everyone. Happy Friday. This is Ilian Yotov, founder of AllThingsForex.com and a host of the popular All Things Forex live daily broadcast. I would like to invite you to listen to my program Monday through Friday on AllThingsForex.com. Membership is absolutely free of charge, so make sure you go and register there. I'd like to also thank our friends at FX3.com for putting together the series of webinars. And what we're here to discuss today are the top 10 spotlight economic events for yet another busy trading week and potentially crucial trading week for the future fate of the euro and the US dollar. The reason I'm saying that is because following the two-day European Union summit, which is winding down as we speak today, we are going to keep the focus on the euro ahead of the European Central Bank's interest rate announcement next Thursday. And shortly after that, we're going to see another major event which will impact the future fate of the US dollar and the future monetary policies of the Federal Reserve, the US Central Bank, and that, of course, is the non-farm payrolls and employment situation report, the main gauge of economic health and labor market conditions in the United States. Besides these two events, there's going to be a lot of important data coming from Japan, the Eurozone, the United Kingdom, and the United States as far as manufacturing and services sector conditions in both countries, in not both countries, but all of these major economies, rather. This is why I have chosen the first of the top 10 economic events for next week to be the Japanese Tankan Index. Now, this is a very important survey which is done every quarter by the Bank of Japan. It surveys large and small manufacturers and businesses in order to gauge economic conditions in the manufacturing and the non-manufacturing sector. And if you paid attention to the Japanese economic data last night, we had some signs that things are deteriorating again economically in Japan. We had industrial production registering bigger than expected decline. We had the inflation pressures falling below 0%, which is in deflation territory, the first decline for the first 4 months. Industrial production fell 3.1% month over month in May, the largest decline since April. And the June Purchasing Managers Index also fell below 50, not significantly below 50, a reading of 49.9, but it was the first contraction in a Purchasing Managers Index since November of last year. Now, many of you know Japan's still trying to recover from the devastating impact of the tsunami and the earthquake and the nuclear disaster that occurred last year. And there were in recent months some signs that things are improving. But now we're beginning to see that things are beginning to deteriorate as well, which is not surprising. It is in line with the global slowdown that we have been observing in the last few months. So we'll pay attention to the Japanese Tankan Index, which is not expected to impress a whole lot. It looks like the consensus forecasts are predicting another reading of -4 for the manufacturing industries, and that is going to be the same reading as the -4 reading in the first quarter. So the Tankan Manufacturing Index is expected to show a reading of -4. There may be some slight improvement with the non-manufacturing index. The consensus was for a reading of 6 compared to the previous reading of 5. If there's negative surprises there, then we can have another economic report on Sunday night, 7:50 p.m. Eastern Time, that shows that conditions are deteriorating in Japan. Now, because of the great news that some may have perceived as great news, I'm not arguing that this decisions that were made at the European Union Summit were necessarily bad. They're in line with our forecast for a scenario where the euro targets the existing bottom of the existing range, and then on some positive news in the aftermath of the European Union Summit, it rallies and jumps higher, produces a relief rally. So no shocking development there, with the euro bouncing higher by almost 300 pips in the last 24 hours. I'm not surprised by that, and hopefully you aren't surprised by that, especially if you've been joining this webinar last Friday or in recent weeks. But the Japanese yen also came under pressure, and I will show you the daily chart of, let's start with the dollar against the Japanese yen, where the pressure is not much apparent, but we'll take a quick look at the euro against the Japanese yen. You can see that channel, that range that the euro-yen currency pair has been trading within here for the last few weeks. Bottom of the range was targeted, which was 98.5 area. Yesterday it looked like we might be breaking below that area of support, but not a decisive breakout, with an intraday low at 98.31, which is only, 20 pips? 22 pips below the previous support area, 98.53. Anyone who listens to me regularly knows that this is not what I would classify as a decisive breakout. As a rule of thumb, for those of you not familiar with my personal preferences and methodologies, and in particular my quarters theory methodology, I do not consider a price move that is 25 pips or less as a breakout. I consider that, as I call it, an overshoot above an important resistance level or below an important support level. And this is exactly what we saw with the euro-yen currency pair. Yes, it's overshooting by 22 pips below an important support level. It looks like a breakout, but as I've explained many times before, it isn't really, at least to me, a breakout. It is a fake breakout. Some would call it even a cat fake. And the end result is a move in the opposite direction as a result of these overshoots that do not produce decisive breakouts. And so no surprise with the positive news after the European Union summit. I guess the most positive news is that European leaders have agreed that the European Stability Mechanism, which is the permanent bailout fund, which is due to be activated in the early days of July, which is next week. The European Stability Mechanism will be able to stabilize the bond markets with primary and secondary markets without obliging countries complying with European Union budget rules to adopt any extra austerity measures or to implement any economic reforms, which means that it's going to be a quick type of availability of these funds from the permanent European Stability Mechanism fund, which is due to replace the temporary fund, the European Financial Stability Facility. So this is what the markets like the most from the European Union Summit agreements. The European Union also agreed to allow the European Stability Mechanism to lend directly to recapitalize banks. So not only provide funding to countries who are troubled as far as raising funds on the bond markets, buying bonds of such countries, the ESM, but also the ESM could lend money directly to the banks without preferential seniority status. It's another news that was perceived well by the markets, at least at a first glance. However, leaders have agreed now that this will come about only after the euro area sets up a single banking supervisor that will be run by the European Central Bank. Plans for which the European Commission has been tasked to create by year end. That's the end of 2012. So again, something being created at a later date. Does that sound to you familiar to what we have witnessed in the last 3 years after 19 European Union summits? It sounds familiar. Promises for something to come up at some date in the future. the only difference today is that the bailout fund would be able to lend the money more quickly than they have been before. And the lack of budget rules, complying with budget rules, or adopting any economic reforms or additional austerity measures, that's positive as well, because it's not going to weigh on economic growth in countries that are already struggling anyway to create any kind of growth. So that was the positive thing. When you take a closer look, however, at the European Union summit outcome, that was the only positive. The structural problems of the Eurozone, there are some proposals that within the next decade there's going to be a move in that direction towards closer fiscal union, towards closer political union. Will the markets be happy with within the next decade type of a time frame? Is it fast enough? It looks also that this lifeline, so to say, that was created or agreed upon is being created mainly for the big economies that are being impacted by the debt crisis now, which is Italy and Spain. Spain's already asked for a bailout for its banks. Some are forecasting that they might be forced to ask for a bailout for the entire country, which the bank bailout could be up to 100 billion euros. Moody's is estimating about 300 additional billion euros to bail out the Spanish government. And Italy might be the next one in line with hat in hand to also ask for a bailout. Another issue that was not addressed, according to some experts and economists, was Greece. Is Greece going to be able to meet its debt obligations that are coming due? They're running out of funds within the next month or so. I personally have not seen anything at the European Union Summit, any announcements about what's going to be given, if anything, to Greece. Will further funding be provided to that country? So at the end of it all, we could see the same scenario where we get a nice little relief rally after the summit, and when the markets take a closer look at what was agreed upon or decided at the summit, then that optimism could start fading away, and the ultimate relief rallies for the euro, for example, could start also fizzling. So for the most part, the euro-yen pair is simply trading within that existing range. The top of the range is 101.65. We have gotten as high as 100.98 in a trading session today. Could be another move a little bit higher to the top of this range. And if disappointment sets back in quickly after that, we'll see the euro being put under pressure once again. But we'll watch the Japanese economic report, which will kick things up for us next on Sunday night. And then the week is going to get even busier as we get into the upcoming days, despite of it being a holiday shortened week because of the 4th of July holiday here in the United States on Wednesday. The other important event next week is going to be the Eurozone Manufacturing Purchasing Managers Index on Monday at 4 a.m. Eastern Time. Another month of contraction in the Eurozone manufacturing sector is expected. The consensus forecast is expecting that the manufacturing index for the month of June is going to stay at 44.8, which is deep into contraction territory. A reading below 50 indicates contraction. A reading above 50 indicates expansion. So another month of contraction for the Eurozone manufacturing sector. Shortly after that, we're going to see the June manufacturing index from the Institute for Supply Management, which is forecast to pull back as well. Again, it is in line with the deteriorating economic conditions globally and in the United States that we witnessed in the last 2-3 months. The June manufacturing index is expected to reach 52.5, some consensus forecasts have it even a little bit lower, 52.1, compared with 53.3 reading in the previous month. Now, granted, this is a pullback, but it is still a reading above 50, which indicates expansion, although at a slower pace with the U.S. manufacturing sector, compared with the Eurozone, which is in contraction territory for another consecutive month in the month of June. At least that's the consensus forecast. Then we're going to see the next event being a major central bank announcement, and that's the Reserve Bank of Australia interest rate announcement coming up on Tuesday morning at 12:30 a.m. Eastern Time. Now, Reserve Bank of Australia has been one of the central banks that has been in an easing mode, so to say. They have cut interest rates a few times. The consensus forecasts are not expecting the Reserve Bank of Australia to cut rates on Tuesday, but I beg to differ, and the reason why I beg to differ is because the Federal Reserve was the first major central bank last week in the aftermath of that had a meeting in the aftermath of the Greek election. And as I explained last Friday on this program, and in my Outlook, and my newsletter, by the way, when you register for the if you go to allthingsforex.com, you'll see a brand new website which we launched a couple of weeks ago. Much better user experience. And one of the benefits of being a member of allthingsforex.com is you get access to the daily Outlook and the broadcast and a 1 hour live on the market analysis of the currency markets. But also you get to an access to the weekly newsletter that we put together. And so in my weekly newsletter last week, as an outlook to the upcoming week, I explained that the Federal Reserve's announcement in the last few weeks also in the newsletter outlooks. I've explained that the Fed was going to be the first major central bank who announces its decision on monetary policy and interest rates in the aftermath of the Greek election. And because of that, the Fed's decision, as I said a few weeks ago, is going to be a policy guiding decision for other major central banks, which means that the Fed could give the impetus, and the Fed's decision could give the impetus and guide the decisions of other major central banks' meetings that are going to follow the Fed. And that includes the Reserve Bank of Australia, that includes the Bank of England, that includes the European Central Bank, all of these three central, and the Bank of Japan as well later on in the month of July. But next week, these three central banks are going to meet, and they're going to decide how to proceed further with monetary policy. And I feel that there is a chance, although the consensus forecasts are not expecting the Reserve Bank of Australia, nor the European Central Bank for that matter, to ease monetary policy further, I would not exclude that possibility, because the Fed decided to ease monetary policy further here in the United States. They didn't exactly do QE number 3. They pumped another $267 billion into the U.S. economy by extending the so-called Operation Twist. But it is a form of monetary policy easing. And so I wouldn't be surprised if these other major central banks that followed the Fed decision, if they were to be in an easing mode as well, taking their clues from the Federal Reserve's announcement. So if the Reserve Bank of Australia were to unexpectedly, to some people, cut interest rates maybe by another 25 basis points on Tuesday morning, then obviously that would weigh on the Australian dollar. It would be a little bit of a surprise, I guess, for some people who are not expecting the Reserve Bank of Australia to cut rates at the meeting on Tuesday. Now, the Australian dollar today is taking full advantage of this risk-on rally, and it is reaching the large quarter point area at the $0.0250. It's an important price level in my quarter theory. It's a large quarter point at $0.0250 with an intraday high, surprise, at $0.0249, which is only a pip below $0.0250. That is where it is lingering at this point, and it's attempting to break above previous resistance of the $0.0223, which was the previous high from the previous leg up for the Aussie versus the US dollar. It is now completing the quarter to $0.0250. It's an important development on a pullback. The Aussie dollar pair here went through a little bit of a price correction, moved to the major large quarter point at $1, even reached lows that were at 0.9967, a little bit below the parity level. It seems like it found support within that area. And the positive news from the European Union summit and the risk rally is really helping the Aussie dollar pair complete this quarter to $0.0250 from the parity level $1 to $0.0250. A decisive break above this area and the large quarter point $0.0250 is going to open the door for the Aussie to gain further, a little bit above $1.04, a little bit below $1.05. You have a very important area of resistance right here, a triple top resistance even, it looks to me like, and that is the $0.04 and a half, $0.0473 area. So that's an important area to watch in case the Australian dollar manages to break out successfully above $0.0250, and then these resistance levels shortly above $0.03, you have $0.0329 and then $0.0378, which is also double top resistance here from back in 2011. So that's the area that we're going to watch. A failure to break above $0.0250, $0.0329, $0.0371 could quickly see the Australian dollar being put under pressure, especially if the market disappointment sets in when the markets realize that the European Union summit did not address some of the important things that needed to be addressed, that the market wanted to be addressed. And if risk aversion sets back in, if we get to see the Reserve Bank of Australia easing monetary policy further, cutting rates potentially next Tuesday, those are all factors that could weigh on the Australian dollar. There's also some important, of course, like the retail sales and a trade balance from Australia that did not make it into my top 10 list, but that, of course, does not mean that we should completely disregard such economic reports. For example, the Australian retail sales are due, let me see here, on Tuesday night, if I'm not mistaken, following the Reserve Bank of Australia's announcement. And then on Wednesday, we'll see the Australian trade balance on Wednesday night. So we'll keep an eye on these reports, especially if you like to follow the developments with the Australian dollar. Shortly after the Reserve Bank of Australia, well, not shortly, the following day after the Reserve Bank of Australia's announcement, next Wednesday, we're going to see the Eurozone Services Purchasing Managers Index. Now, I mentioned that on Monday, we are expecting that the Manufacturing Purchasing Managers Index is going to spend another month in contraction territory in the Eurozone. Well, that is the expectation for the Services Purchasing Managers Index as well, with a reading of 46.8, which, again, is below 50. So yet another month in June that the services sector of the Eurozone economy spends in contraction territory. It doesn't sound to me like a whole lot of growth being created in the Eurozone throughout the second quarter of this year, because, as you already know, we're wrapping up the second quarter here today and tomorrow. So watch for more signs of economic weakness that might be coming from the Eurozone. Also following the Services Purchasing Managers Index is another important report, which is the final reading for the Eurozone gross domestic product, the main measure of economic activity and growth in the Eurozone. And Germany was the one who saved the overall Eurozone GDP reading. In a previous estimate, stronger than expected growth in Germany was able to lift up the overall GDP numbers from the Eurozone and caused the Eurozone GDP to show 0% growth, which some will say, well, how is that positive if the Eurozone had 0% growth quarter over quarter in the first quarter of 2012? Well, it was better than expected because the majority of market participants, including myself, experts, strategists, analysts, economists, were forecasting a recession in the Eurozone, a contraction in the first quarter. The German GDP numbers really helped the overall Eurozone GDP figures. But that's just numbers. In actuality, we're not seeing any type of growth. It's non-existent, quarter over quarter at least, in the Eurozone in the first quarter. And that's expected the final reading to show exactly that 0% growth. But if these numbers were to be revised somehow, well, if there's a downward revision, then that would confirm the market's expectations that the Eurozone was in a double-dip recession, meaning 2 consecutive quarters of negative economic growth, contraction in the fourth quarter of 2011, and then if somehow these GDP numbers on Wednesday morning are revised lower, then that would confirm the market's expectations that the Eurozone was in a double-dip recession, 2 consecutive quarters of negative economic growth. I would not be surprised to see that, but the consensus forecasts are expecting a flat reading, 0% quarter-over-quarter growth in the first quarter. And as I've said, we've been paying close attention to the economic data from the Eurozone throughout the second quarter of 2012. It does not look to me that in the second quarter conditions were much better compared with the fourth quarter of 2011 and compared with the first quarter of 2012. Now, these reports are going to come ahead of the European Central Bank's announcement. So obviously, if we get to see further signs of economic weakness from the Eurozone, that can influence the decision of European Central Bank policymakers and could push them closer to making a decision to do more easing. Before the European Central Bank's announcement, however, 45 minutes before the European Central Bank's announcement, we're going to see the Bank of England announcing its decision on interest rates and monetary policy. And I think, as I wrote also in my outlook for FX Street, which I think they published today, for the Bank of England's announcement, I think it's pretty much a given that the Bank of England is going to do more easing, meaning that they are now expected that they're going to expand the size of their quantitative easing program, the so-called asset purchase program. The only unknown, in my opinion, is the size of the expansion. And considering that the current level is 325 billion, and the previous time the expansion was by 50 billion, it does make sense for the Bank of England to increase the size of the asset purchase program by 50 billion more pounds, which will bring it to 375 billion. I would not be surprised if they did something even more as far as larger increase, maybe anywhere from 50 to 75 billion, maybe round things up to 400 billion from 325. Either 375 or 400 billion, that's going to be the range of expansion in a Bank of England's asset purchase program. Now, we're seeing the British pound breaking again above today an important level of resistance. I will take you to the daily chart of the pound-dollar currency pair. Let's see here. That level of resistance is the $1.56 level. And we've been talking about it for a few weeks now on this program. It continued to be an important level as the pound was breaking below that level. Obviously, it unleashed further weakness. However, the pound found support yesterday a little bit below the $1.55 large quarter point. And today's intraday low even managed to stay above $1.55 at the low at the $1.55.05. We're now seeing the pound back on the rise, breaking earlier today above $1.56, moving above $1.56, now reaching as high as $1.5704 in a trading session today, which is not far from the previous resistance at the $1.5776, a little bit above the large quarter point at the $1.5750. That's a level to watch. That level can be very quickly challenged and targeted if the pound manages to break above this double top resistance, which is $1.5716 and $1.5715, two identical highs that were reached on May 28th and May 29th. So watch this first area of resistance there shortly above $1.57, $1.5715, 16 levels. If they are broken above, the next level would be the large quarter point, $1.5750, $1.5776. However, although I think that the market, as I said, is pretty much a given, everyone's expecting that the Bank of England will ease monetary policy further. At the last monetary policy meeting, there was a very small, tiny margin of majority that prevented the Bank of England Monetary Policy Committee to increase the size of the asset purchase program and do more quantitative easing. Considering what's been happening here in the last month since the previous meeting of the Bank of England, considering the Fed's policy guiding decision, as I explained earlier, for other major central banks, including the Bank of England, the Fed eased monetary policy further. I don't doubt that the Bank of England will follow suit, the footsteps of the Fed, and this is why I said it's pretty much a given. Everyone's expecting that the Bank of England's going to increase the size of their asset purchase program. I think that for the most part, these expectations have been priced in to the pound's exchange rate versus the dollar or other currency majors. But I still would not be surprised in the days leading to the Bank of England's announcement if the pound is being put under pressure. I think it's largely priced in these expectations, but I wouldn't be surprised if the pound comes under pressure, especially if it fails to break any of these previous resistance levels, and especially the $1.5776. If the pound stays below that level, if it doesn't break above it, we could quickly see it falling back to that support around $1.56, and maybe even challenging the lows of this week, a little bit below the $1.55 level. For the most part, however, I think that next week we could see the pound, maybe trailing within this range of 250 pips, the large quarter range between $1.55, $1.5750. That could be the range of the pound-dollar pair is stuck within throughout next week. If it doesn't break above $1.5776, we could make a move to the large quarter point below at the $1.55, or at least to support at $1.56. Following the Bank of England's interest rate announcement, we're going to see the big event of next week, and that's the European Central Bank interest rate announcement. Very quickly, before I talk about this, though, let me answer a question. What purpose does the 2-day moving average serve? It's just a way for me to follow price close enough, but not exactly, as if I were to put one period moving average. 2 periods is close enough to me, not exactly one. That's the only purpose, so I can visualize better the price moves and the direction that the price is heading. The European Central Bank interest rate announcement will be one of the big events next week besides the non-farm payrolls report. As I said earlier, the Fed's decision was a policy guiding decision, and I would not be surprised if the Reserve Bank of Australia and the Bank of England next week, the other two central banks, are also in the rate-cutting mode, or monetary policy easing mode, rather, with the Bank of England doing the expansion of their asset purchase program. And as I said also earlier, despite of the consensus forecasts, they're not expecting the European Central Bank to ease monetary policy further or to cut rates. I am not excluding the possibility that they could decide to choose that option. Creating economic growth in a Eurozone now seems to be the main focus of European Union leaders and it seems that the European Central Bank is also focused on that. Now that we know after the European Union Summit that funds will be quickly, readily available for any future bailouts without additional strings attached, no austerity requirements, no economic reforms requirements, that's the positive. The European Central Bank does not need to go directly buy bonds anymore. Well, they could decide to do that, but I don't think that that's a necessity at this point. The European Central Bank had three options that I've been talking about for months. And the three options were buy more bonds as a form of easing monetary policy further, buy more bonds, do another round of long-term refinancing operation number 3 to recapitalize banks, offer them cheap loans after 3-year payback period at a low benchmark rate at 1%. Or the third option was to cut rates. Now that the ESM is being activated, that's the European Stability Mechanism, it's the permanent fund. It's aimed to be activated in the early days of June. And now that the European Union leaders have agreed, the funds from ESM not only to be used to buy bonds of troubled nations, but also to allow the ESM to lend directly to recapitalize banks. Then the European Central Bank may not need to do more bond buying or another round of LTRO, long-term refinancing operation for banks. So the only option that could be utilized as far as further easing that is now left for the European Central Bank, that's more likely to be utilized, would be an interest rate cut to bring benchmark rates lower, stimulate economic growth and lending in the Eurozone. This is why I wouldn't be surprised if that option is utilized. But as I have said for months, neither one of these three options, including cutting rates, is going to be considered as a Euro positive. Long run it could be, of course, if it sparks, spurs economic growth and so forth and so on. But the short-term reaction of the market is going to a rate cut by the European Central Bank, in my opinion, is going to be a Euro negative. And so don't be surprised if on expectations that the European Central Bank could do more easing, if we get to see next week the Euro relief rally that we're seeing in the last 24 hours quickly fizzling. As I mentioned earlier, I was showing you the Euro against the Japanese yen. It is pretty much the same picture with the Euro versus the US dollar. This is the daily chart of the Euro-dollar pair. Last Friday, if you tuned into this weekly Outlook webinar, you probably remember I spoke that I would not be surprised ahead of the important event, ahead of the European Union Summit, if the Euro-dollar pair were to trail and trade within that existing range, which was the range between $1.2434, serving as the bottom of the range, and the large quarter point at the $1.2750, serving as the top of the range. In the aftermath of the Greek election, the euro rallied. However, for 3 consecutive trading sessions, the euro failed to break above $1.2750. It established a triple top resistance, double top at least, below that important price level in my quarters theory, which was a sign of weakness. So the next logical move was for the euro to fall on anxieties, uncertainty ahead of the European Union Summit, for the euro to fall back to the bottom of the existing range. What was the bottom of the range? $1.2434. And so exactly that's what we saw throughout this week. Even yesterday, the euro began to test the bottom of the range, overshot below that bottom, reached as high as $1.2406. On the positive news that broke last night, late last night, and into this morning, the euro is staging a nice little relief rally, almost 300 pips, by the way, from the lows yesterday at $1.2406 to an intraday high today at the $1.2691. So heading back to the top of this range. This is a scenario that I have prepared you for the last 2 weeks. And it's not really shocking to see that euro relief rally when optimism sets back in. that takes the euro-dollar exchange rate back towards the top of the existing range. Now, speaking about the top of the existing range, that's going to be a very important price level to watch. Needless to say, throughout next week. Is the euro relief rally going to have further legs to go that takes the euro above the large quarter point at the $1.2750? And if there should be a decisive breakout above this double top resistance shortly below $1.2750 at $1.2746, then as I said previously, we could see the euro-dollar pair quickly challenging another important level of resistance, double top resistance at the $1.2823. That would be the next level of steep resistance ahead for the euro. If, however, the euro does not break above these two levels, $1.2750 and $1.2823, do not be surprised if the relief rally begins to fizzle again. We have seen this scenario playing out in the last couple of weeks, where we witnessed a nice move higher, a nice little relief rally for the euro quickly fizzling, and the bottom of the existing range being challenged once again. And I think that the expectations that the European Central Bank could do more easing is also going to weigh on the euro ahead of the European Central Bank's announcement next Thursday. So these expectations, and if pessimism also were to set back in, and we get to see the markets, after reading closer what was decided and agreed upon at the European Union Summit, and they realized that the fundamental structural problems of the Eurozone, the move towards closer fiscal and political union, was not what the European Union Summit decided, just proposed, but something that might be done within the next decade. That might be too long of a time frame for the markets and the investors who grow increasingly more impatient with what's happening there as far as the debt crisis is concerned. Now that Spain has been engulfed by the fire of the debt crisis, and Italy seems to be lining up as the next potential candidate for a bailout, and Italy really is a train wreck. If you listen to my daily All Things Forex program, or if you're a member of allthingsforex.com and you read our newsletters, you know some of the things that I've been writing there about Italy and conditions there. So don't be surprised if this relief rally starts fizzling as early as next week. And we'll watch, obviously, these resistance levels here to see the first signs that the rally may be visible. So moving forward with the top 10 economic events for next week after the European Central Bank's announcement, the focus is going to fall on the U.S. dollar as we're heading into Friday's non-farm payrolls report. But before that, we're going to see the Institute for Supply Management non-manufacturing index. And that's, of course, an indicator of services sector activity. The non-manufacturing index in the U.S. is also expected, just as the manufacturing index scheduled for release earlier in the week, to pull back a little bit from a reading of 53.7 in May to a reading of 53.1 in the month of June. Obviously, it's a reading above 50, which is still in expansion territory, contrary to the Eurozone manufacturing and non-manufacturing services indexes. The U.S. is still, these two sectors in the U.S. are still expanding, but they are expanding in recent months at a slower pace, and that's what we see with the ISM non-manufacturing index. That will lead us to the non-farm payrolls report next Friday, the most important U.S. economic event for next week. And I have said a lot about the deteriorating economic and labor market conditions in the United States that we're witnessing becoming a trend in the last couple of months. When it was happening 3 months ago, I said, well, 1 month is not going to be enough to convince the Federal Reserve to do more easing because it's not a trend. But I warned at that time, and that was 3 months ago, that if this was to become a trend that lasts for at least a couple of months, then we should not be surprised if the Fed is forced to do more monetary policy easing. And that unfortunately did become a trend. Deteriorating conditions in the labor market were more than apparent, with disappointing payrolls for 3 consecutive months. Especially last month in May, we saw only 69,000 jobs being created by the U.S. economy. And so that, leading to that 3 months of negative economic data and labor market data from the U.S., it wasn't shocking really to see the Fed expanding Operation Twist and pumping $267 more billion into the U.S. economy. And on top of that, the Fed also said that they're prepared to do more besides the Operation Twist, which means QE number 3. And so if we continue to see the U.S. labor market showing signs of weakness, don't be shocked if QE number 3 is still in a picture and still a possibility as an option from the Fed to be deployed. And that is what the market is going to gauge, QE number 3 odds in the aftermath of the non-farm payrolls report. And if it is another disappointing non-farm payrolls report that shows weakness in the U.S. labor market, then QE number 3 expectations could weigh on the U.S. dollar. The consensus forecasts are pretty mixed at this point. Neither one of them, however, is expecting the U.S. economy to add more than 100,000 jobs. The more optimistic ones expect 100,000. Some less optimistic ones expect 92,000. Reuters consensus forecast has the number even lower at 89,000, which is only 20,000 more than 69. The number that the Fed wants to see, as Mr. Bernanke told us a couple of weeks ago, last week, is more than 100,000 per month job creation. So watch these figures and make sure to join me at allthingsforex.com. Listen to my daily All Things Forex broadcast Monday through Friday, 1-hour program. You can also follow us on Twitter at allthingsforex. With that said, thank you very much for attending today's webinar. Have a great afternoon and a great weekend, and I will see you again in a couple of weeks.